In this video, we're going to explain how to build your dividend growth portfolio from scratch. Before we begin, be sure to subscribe to this channel to stay in touch with the latest investing content from Dividend. Investing in stocks can seem extremely complicated as there is a staggering amount of industry-specific knowledge in investing. Fortunately, you don't need to know everything to do well in the stock market. In fact, success can be boiled down into one sentence. Invest in great businesses with strong competitive advantages and shareholder-friendly managements trading at fair or better prices. A great place to start is with the dividend aristocrats. These are stocks with 25-plus years of rising dividends, implying that they are businesses with strong competitive advantages and shareholder-friendly managements that can continue to generate attractive levels of free cash flow through numerous economic cycles. The rest of this video discusses in detail a step-by-step process for how to build a dividend growth portfolio. Step 1. Choosing the right stockbroker. Today, there are a plethora of online stockbrokers. They give investors plenty of choices to choose from to fit their particular needs, with more sophisticated investors favoring brokers that allow them to borrow money to buy stocks at lower interest rates or trade complicated stock options with low commissions. However, for an unsophisticated investor just getting started, we recommend picking the broker that has the lowest trading fees, since, as a small self-directed investor, the largest fees you will incur are when you trade. There are a growing number of brokerage accounts that now offer investors fee-free trading. We use Interactive Brokers at Dividend, which has an excellent combination of low fees and a great execution platform. Step 2. Choosing which securities to buy. In the past, the only way to gain exposure to the financial markets was by investing in individual securities. That changed with the introduction of the mutual fund and later the exchange-traded fund, ETF. These offerings are financial products where retail investors like you and I purchase units of a fund and our money is professionally managed by an expert investment manager. While we oppose mutual funds because of their high fees, ETFs are a low-cost way for investors to gain diversification and access to the financial markets. ETFs are traded through the same mechanism as shares on the stock exchange. You can purchase ETFs in your brokerage account and hold them for as long or as short as you like, just as with stocks. There is much back and forth in the investing industry about what is better, ETFs or individual stocks. The truth is that both options have pros and cons. Pro number 1, investing in dividend ETFs provide wide diversification. This is helpful for investors with small portfolios as they can get the necessary diversification from owning multiple stocks without wasting money on many brokerage commission fees. Pro number 2, investing in dividend ETFs has a low time commitment. Once purchased, investors can sit and forget about their ETF. No additional research is required since the fund is being managed by a talented team of investment professionals. Pro number 3, dividend ETFs almost always have lower expense ratios than their mutual fund counterparts. There are several dividend ETFs that have annual expense ratios below 0.1%. Most dividend mutual funds would have a fee of 1% or more, which amounts of $1,000 of annual fees on a $100,000 portfolio. Con number 1, dividend ETFs are always more expensive than owning individual stocks. After the initial purchase is made, individual stocks will always have an expense ratio of 0%. There is no cost to hold a stock, regardless of the holding period. On number two, you cannot hand select which businesses you own with a dividend ETF. Dividend ETFs give you no control over your portfolio. You cannot buy or sell individual stocks, which means you cannot fine-tune your strategy to match your specific needs. The endless customization possibilities are one of the major advantages of buying individual stocks over ETFs. Conclusion: there is nothing necessarily wrong with dividend ETFs for investors with minimal time or interest in investing. ETFs are an excellent alternative to high-fee mutual funds. With that being said, I prefer to invest in individual businesses, not markets. The rest of this video will assume you do as well. Step 3. Where to find great businesses. Sure Dividend generally recommends two databases of stocks as a source of high-quality dividend-paying businesses. Both of them are based on consecutive streaks of dividend increases. Consecutive dividend increases are important because they demonstrate two things. One, the business is doing well, and two, the management is shareholder friendly. With regards to the first point, a company cannot raise its dividend if earnings are not also increasing. While dividends may outpace earnings in the short term, this is impossible over the long term. A very long streak of constantly rising dividends means that a company has grown its business through everything the market has thrown at it. Secondly, shareholder-friendly management teams are a telltale sign of a great business. Exceptional people create exceptional companies, plain and simple. The first source of great businesses we recommend is the Dividend Aristocrats Index. In order to be a dividend aristocrat, a company must 1. Be in the S&P 500, 2. Have 25 plus consecutive years of dividend increases, and 3. Meet certain minimum size and liquidity requirements. The dividend aristocrats have historically outperformed the overall stock market as measured by the S&P 500 index. Another great place to look for high-quality businesses is the Dividend Kings. Like the Dividend Aristocrats, the Dividend Kings list is based on historical dividend increases, except it's even more exclusive. To be a Dividend King, a company must have 50-plus years of consecutive dividend increases. Either of these databases are great places to look for high-quality dividend stocks to hold for the long run. Step 4. How to know if a great business is trading at fair or better prices. It is important to remember that even the best company becomes a poor investment if an investor pays too high a price. A very quick and easy rule of thumb is to look for great businesses trading at or below the S&P 500's price-to-earnings ratio. If a business is higher than average quality, you would think it would command a higher price-to-earnings ratio than the market average, as measured by the S&P 500. Beyond comparing stocks to the overall market, investors should compare a business's price-to-earnings ratio to both 1. Its 10-year historical average price-to-earnings ratio, and 2. Its competitors' price-to-earnings ratio. In doing so, it is important to remember to use adjusted earnings when comparing price-to-earnings multiples. GAAP earnings can be reduced by one-time effects such as acquisition costs or depreciation charges. Similarly, GAAP earnings can be artificially inflated if the company sells assets. These charges are accounting-based, not reality-based, and may not truly communicate the long-term earnings power of a business. Step 5. Buying your first stock. Once you have identified a high-quality business trading at an attractive valuation, it is time to buy. Buying stocks can seem as complicated as analyzing stocks. It is not as simple as just pushing buy. There are a number of different order types that investors can use, depending on the circumstances. For simplicity's sake, the beginning investor should only be concerned with two types of orders: 1. Market order, and 2. Limit order. A market order is when you communicate to your broker to buy a certain stock at prevailing market prices. Market orders are always the quickest way to execute a trade. Market orders have downsides, however. If the stock prices moves quickly after you place your order, you may end up buying the stock at a higher price than you wanted. Limit orders are the solution to this problem. A limit order is when you communicate to your broker to buy certain stock, but only at a price of X or below. For example, if Target TGT was trading at $55 and you saw the value at $50, you could place a limit order for $50, and the order might never be filled unless Target stock dropped to $50 or below. There are many other types of buy orders that are more complicated than the two mentioned above, and there are also equivalent sell orders. However, limit orders are generally the best way to ensure that you are getting a fair or better price on a trade. Step 6. How many stocks should you hold? There is a trade-off with diversification. The more stocks you hold, the safer you are if any one of them implodes. On the other hand, you have less to gain from the stocks you hold that do well. Fortunately, studies have shown that there is a happy medium. Over 90% of the maximum benefit of diversification is derived from portfolios of 20 stocks. There are also advantages to holding fewer stocks. Holding 20 stocks means you get to invest in your best ideas. You can own the businesses you are most comfortable holding, the ones that you believe have the greatest total return potential. Holding a large portfolio of 100 or 200 stocks also requires a large time commitment and is virtually impossible to keep up with. It's hard to really know 100 plus businesses. Keeping up with the quarterly earnings reports of this many businesses would be a huge endeavor, much less so for 20 businesses. You can't just own any 20 stocks and be diversified, however. As an example, if you owned 20 upstream oil corporations, you would not be well diversified. Dividend growth investors should look to invest in different sectors to gain exposure to different types of great businesses. Step 7. Dividend growth portfolio building strategy. Diversified dividend income will not be created overnight. The process will take time. Just like all important things in life, instead of thinking you will never make it because you don't have $100,000 or $1 million to build your portfolio, focus on saving and investing the same amount each month. I recommend buying the highest ranked stock you own the least of every month, based on your specific criteria. Each criterion should be selected to either increase returns or reduce risk. The longer you invest, the more money you will have to invest, and the more diversified your portfolio will become. The best investments are long-term in nature. Once a stock is purchased, investors should prefer to let it compound their wealth indefinitely. A long-term orientation also provides individual investors with a competitive advantage over institutional investors, like pension plans and mutual funds, whose performance is judged on a quarter-over-quarter basis. With that being said, holding a stock for long-term is not always possible, since businesses that were great at one time sometimes lose their competitive advantage. This can happen by management losing its way, technology changes, or by competitors finding a way to destroy or copy the company's competitive advantage. When a business loses its ability to compound your wealth through rising dividend payments, it's time to sell. The primary sell criteria that we use at Sure Dividend is to sell when a business cuts or eliminates its dividend. This is a very clear sign from management that either 1. The dividend is not important, shareholders don't matter, or 2. The business cannot sustain its dividend, business is in decline. In either case, that is not the type of investment likely to generate long-term wealth. Of course, there are exceptions. Sometimes businesses rebound after dividend cuts. However, the historical record shows that dividend cutters make poor investments on average. More specifically, dividend cutters have had a lower return and a higher standard deviation than all other classes of stocks, resulting in terrible performance on a risk-adjusted basis. Fortunately, there are typically many more dividend growers and initiators than dividend cutters and eliminators. This makes it easier and less risky for dividend growth investors to execute their investment strategy. There is one good reason to sell a dividend growth stock. If it becomes wildly and absurdly overvalued, it is better to profit from the overconfidence by selling than to participate in it. This benefits investors in a number of ways. Stocks with lower valuations have better total return potential, all else being equal. Similarly, two companies that have the same earnings and payout ratios but with different valuations will also have different dividend yields. The lower valued company will generate more dividend income for shareholders. Step 8. Stay disciplined. What sets apart those who will retire wealthy from the rest is the amount of discipline you have to stick with the plan you lay out. If your investment strategy is sound and you follow it diligently, you are likely to do well in the market over time. The stock market does not go up in a straight line. You can experience losses of 50% or more investing only in stocks. If you have the fortitude to persevere through market downturns, you can benefit from the compounding effect of owning fantastic businesses over long periods of time. On the other hand, if you sell when things look their worst, you will likely underperform the market by a wide margin. Staying fully invested through market cycles appears to be the best strategy. Missing a few key days over the long run can have a profound effect on investment performance. Sadly, most individual investors tend to buy and sell too often. In fact, a recent study of 78,000 individual investors found that when individual investors sell a stock to buy another, the stock they sold outperforms the stock they purchased on average. This means that human behavior lends itself towards buying and selling at the wrong times. What, then, is the solution? Practice do-nothing investing. Don't sell stocks without a very good reason. Price declines are not a good reason unless the underlying business has deteriorated. Compare investing to grocery shopping. If you bought steak for $10 and it went on sale for $8, would you go back and return the steak you had already purchased? No, you would buy more. When a stock price declines, you can buy more for a better deal, assuming the underlying business has not significantly changed. This makes stock declines the right time to add to your positions, not sell them. Why is investing important? Because the average retirement age in the United States is increasing. Both the age people expect to retire and the age at which they actually retire is trending upward. This should not be the case. People should be retiring earlier. The national GDP has marched upward over the last decade, yet people are not able to retire when they want. Dividend growth investing will help you build a portfolio that pays growing dividend income during retirement. This can lead to retirement on time or even early retirement.